Hello and welcome to our latest Insider interview. I'm Kyle Caldwell and today I have with me Guy Anderson, who is fund manager of the Mercantile Investment Trust. Guy, thanks for coming in today.
Thank you for having me.
So to kick off, could you give us a run through of your investment process and what the investment trust is seeking to achieve?
Yeah, of course. So Mercantile is looking to deliver long-term capital growth for our shareholders by investing in a portfolio of UK-listed mid and small caps. The process that we use is very much fundamental. It is bottom-up stock selection. We spend a lot of time analysing companies and then meeting the management teams. We're looking to get exposure to businesses that have a combination of a number of traits, but essentially we're looking to invest in what we think of as structurally really strong businesses with great growth opportunities, where ultimately their current prospects are not reflected in the market's valuation today.
The part of the market that you invest in, as you've mentioned, UK mid-caps and UK small caps, it's been out of favour over the past couple of years as interest rates have risen. However, there has been an upturn in performance of late. Is this all to do with the fact that interest rates are now falling?
So I think it's definitely one of the factors. So if we step back for a moment, mid and small caps tend to be more cyclical than their larger cap contemporaries, which are more defensive, sweeping generalization. And being more cyclical, they're more exposed to the economy. And in the UK's case of mid and small caps, they're more exposed to the domestic economy. And so clearly when we've been through a period of very significant inflation, alongside which that great big rate hiking cycle, that presented a very difficult landscape for mid and small caps, and so they struggled. But as you rightly said, where we are now, interest rates have peaked, they're on the decline, inflation has normalized, and actually a lot of the economic indicators are improving. And so I think this definitely presents a better operating landscape for those companies and also therefore a better investment opportunity for us.
And in terms of the opportunities you're seeing at the moment, are there any particular types of companies or sectors that are standing out for you?
So one of the changes in the portfolio over the last 12 to 18 months is we have clearly added a number of companies that increase our exposure to that domestic economy and specifically in the consumer space. So two of the largest new investments this year include our investment in Trainline, which we made earlier in the year, which is now around 2% of the portfolio. That is a business which sells railway tickets to predominantly consumers in the UK, but also internationally, and a business where we saw a significant acceleration in ticket sales as a result of both railway journeys recovering still post the pandemic, but also increasing e-ticket penetration. And that latter point I think is really important because I think that's a more sustainable uplift. And their business has predominantly a fixed cost base, and so increases in revenue translate very nicely to a significant pickup in profitability, and that's something we've experienced in the months since making that investment. Another example is Moonpig. So this is the e-card retailer, a company which, I guess in contrast to Trainline, had a fantastic pandemic because, of course, we were all stuck at home. Their sales increased, their customer acquisition increased, but actually they've had a tough time since the pandemic as consumers have been back out buying physical cards, if you will. But what we've seen over the last six plus months now is a return back to growth. And we fundamentally like the business. It's a market leader. It's got strong economics, great customer retention, good returns on capital. But the catalyst for the investment earlier this year was really seeing them return back to growth. And if they can achieve their targets, which boil down to mid-teens EPS growth going forwards, that clearly presents a really attractive investment proposition for us in the portfolio.
And how often are you making changes to the portfolio? And I assume that you're also finding value amongst your existing holdings as well. Could you talk us through some of the names?
So I'd love to find a typical year, but on average, turnover in the portfolio is around 20% per annum. So that would indicate that we're holding our stocks for around 5 years. So we are making quite long-term investment decisions. If I think about what that means in terms of number of stocks, today we've got 80 holdings in the portfolio, so it's quite easy. On average, I guess we're making 16 new investments per annum. This year, we're running a little bit ahead. I think we've made about 20 new investments, which I think talks to the number of interesting opportunities that we're seeing and the breadth of those opportunities. So I find that quite a good indicator for the future, actually.
And in terms of the opportunities that you're seeing in the market at the moment, could you name a couple of examples?
Sure. So as I said, it's quite that long-term investment approach, and so we do have a number of companies in the portfolio that we really have held for multi-years. Some of the largest holdings in the portfolio, if I think sort of Intermediate Capital and 3i, are two of the largest positions that we hold. We've held both of those for over 10 years apiece. So they're fairly mature investments. We clearly think we know what's going on there, but we keep a very close eye on it. But another big investment in the portfolio, for instance, is a company called Cranswick, which is a pork processing business. That's a company that we've held for a number of years, but where the position size does naturally go up and down depending on the relative opportunities that we see. And that's one that we increased the size in the portfolio actually late last year, but because we saw some benefits of the capital that they were investing were going to come through this year and beyond.
And what's your approach when a share that you own is performing well? Do you like to run your winner, or do you take some profits?
Yeah, absolutely. I'm a firm believer. One of the, I guess, key tenets or sort of key elements of our investment process is it's very clearly focused on if an investment is playing out the way we're anticipating, we should run our winners. But the converse is also true. If something changes with an investment that invalidates our investment hypothesis, the default should always be to recycle the capital. So it's to try and cut those losers quickly. Of course, we have to differentiate between genuine change and short-term changes or noise, and that's obviously one of the key tasks that we have to tackle every day.
Mercantile also looks to deliver income as well as capital growth. So how do you approach that? Do you ensure that there's a certain number of companies in the portfolio that are paying a dividend?
So I don't actually look at those sorts of stats. What we look at instead is, first of all, part of the investment process is very much focused on investing in companies that have strong economics, in other words, have good margins and good cash flow profiles. And that focus on cash is really important because we tend to find businesses that actually generate a lot of cash can then obviously either reinvest to drive future growth or can return that cash to us as shareholders. And I think that cash focus is really the key to ensuring that we do get that steady income profile for our end investors. Now, the dividend has grown over the last 30 years at about an 8.5% annual growth rate, so clearly well in excess of inflation. And we've seen, even over the last 10 years, where we've had a few ups and downs because of course, Brexit and the pandemic, we've still grown the dividend at about 7% per annum. One of the things that we keep a very close eye on as we move through the year is the amount of income that we're receiving in the portfolio so that we never have any surprises. And we split that between underlying dividends and special dividends so that we really know the true run rate of cash generation. And things have been pretty good on that front over the last couple of years.
And how do you assess whether a company, it's trying to grow quickly if it's a smaller company, whether they're over-prioritising paying the dividends rather than reinvesting it back into the business?
So a lot of that, I guess, is qualitative through our conversations with management. And we sort of, my team on average, we have between 350 and 400 management meetings per annum with CEOs and CFOs of the businesses in which we're investing. Obviously, I don't attend all of those, but as a team, we have that number. And one of the important sort of discussion points in pretty much every single meeting is capital allocation and how the business is looking to drive growth versus return excess cash to shareholders. And I very much think about it as driving growth and then returning cash to shareholders. So the priority should be on the growth. And we never want a management team to feel capital constrained simply because of a dividend policy.
Thank you very much for your time.
Great. Thank you, Kyle.
That's it for our latest episode of our Insider Interview series. Let us know what you think. You can comment, like, and do hit that subscribe button for more videos. And I'll see you again next time.